So, sir, I mean, over maybe 3 years down the line, our revenue composition will change. I mean, now export is a major contributor for us. So, given the new acquisition.
Export will continue to remain our major focus. Although, in terms of percentage points, it might go up or down a few percentage points, but is that we are expecting in the next 3 to 4 years, export will continue to contribute at least 80% to our overall sales. Because even the products of Hyder, we are planning to in the future to also export the products of Hyder. So our focus over the next 4 to 5 years will continue to be on exports.
And sir, for total revenue, you just mentioned that typically we measure our orders in terms of regular order and project orders. So what is contribution for FY24?
So on an average, our project orders are about 20% of our overall orders.
So 80% basically our revenue comes from the orders which are come from the replacement side.
Replacement side, yes. It's called maintenance replacement. Yeah.
So this is like a recurring business.
Yeah, that's a recurring business. So that depends on customer to customer, segment to segment. So some companies they have their norms of replacing the products once every 6 to 9 months. Some companies have replacement cycle of 1 to 1.5 years. Some have a replacement cycle of 2 years. So that it depends on company to company, on industry to industry.
Sure, sir. Thank you so much, sir.
Thank you so much, Manju.
Thank you, sir. We have our next question from the line of Gokul Maheshwari from Auriga Capital Advisors. Please go ahead.
Yeah, thank you for the opportunity. Sir, I have a question on the industry structure. You mentioned about that you compete against the US companies operating within US when you're exporting to the US market. Could you sort of elaborate in terms of Europe and US markets, who would be the market leader and what is the construct of the industry in terms of number of players and whether it's fragmented or consolidated market?
So in terms of competition, we have some very large players who are our competition both in the US and in the European market. So the likes of Parker, which is a multinational company, it has presence in North America, South America, even in India, in Europe, in Asia, so everywhere. Then there is Senior Flexonics based out of the UK. Then there is a Bigzimel company which is based out of Europe. Then there is Eaton Corporation, I think, which is based in the USA, but it's again a global company. So we have some large companies against whom we compete both in the USA market and in the European market.
And in that sense, what is your edge versus these companies where you are able to win market share in the overseas market?
So when I talk about a competition with these companies, right? So we are competing with the giants. So they have their own set processes and their set parameters that they work with. We our philosophy is slightly different. Is that when we work with our customers, we work to first identify their pain points about what are the issues that they're facing with their say if they are already buying from somebody else. So what are the issues that they're facing from them and how we can resolve those issues. Secondly, in terms of our quality, in terms of our delivery times also, obviously not considering the lead time because that is not in our control, but in terms of the delivery time from date of order to date of dispatch, in terms of the entire basket of products. So we can manufacture, like I said, right from half an inch all the way up to 14 inches in diameter from one location plant. So the ability for customers to buy a wide range of products, from one supplier, obviously, like I said, about the quality of our products and the quality of our service, and all of that at a very good price. So it is a very, compelling prospect for any customer to look at Aeroflex as a preferred vendor, and hence that is the reason why we have been able to continue our position as number one from Asia in terms of our product segment.
What would be your market share in India and US and European market?
Overall, if you see the entire stainless steel flexible hose market, if you see, our market share would be about 1 to 1.5%. Overall in India, from the organized sector, I think our market share would be, I'm assuming, almost 30 to 40%, if not more. And in the Europe, it will be, hard to, say a specific number because I have the data for the entire world.
Okay, fine. And what would be the breakup of the organized and unorganized?
Organized and unorganized in India?
Yes.
I will not have that number right on the top of my head, so I'll probably, get back to you offline on that number. I have to check.
Lastly, just on the promoters, you have two sets. One is the Fat Industries and there is Italica Global. So what is this Italica Global?
So Fat Industries is basically a promoter company, and Italica Global is basically a subsidiary of Fat Industries based in the Middle East.
Okay, fine. Same group then. Great. Thank you so much.
Yes. Thank you.
Thank you, sir. Ladies and gentlemen, we have our next question from the line of Ashutosh Atkare from Universal Sompo General Insurance. Please go ahead.
Yeah. Am I audible?
Yes, you're audible.
Yeah. Just few questions. So you had mentioned that because of the Red Sea crisis, the availability of container was an issue, hence that impacted the margins. So I just wanted to understand, did you see any revenue impact also for the quarter, Q4, and if yes, how much would be the revenue impact for Q4?
In terms of the freight increase, because of the Red Sea crisis, there was a significant jump in the freight, especially the ocean freight, and that is still, ongoing in terms of the hike in the cost. In terms of the impact on the revenue, so like I said in my, earnings call of last quarter, about 10 to 15 days of our sales of Q3 were impacted, and the same was actually carried forward onto Q4. Also, what happened is that because of the delays in these, containers, the orders also got delayed because the customers, tend to postpone their deliveries. So hence, I think by Q1 of this financial year, I think the entire carry forward of revenues would be completed. So in terms of exact, numbers will be hard to say, but I can tell you about 10 to 15 days of revenue got impacted in December, and the same number of days the revenue got impacted in Q4 as well. So I think by next quarter,
could that be quantified as 20 to 30 crores of impact in Q3 and Q4 together, which we'll see in Q1 of FY25?
So what happens is ultimately these revenues get shifted. So the revenues of this quarter will be shifted to Q1. Some of the revenues of Q1 might be, shifted to Q4. Also, what we saw unfortunately is because of some of these, the Red Sea crisis, right? Some of the orders, from our customers, so they have delayed it, to the future quarters. Also, in case of where they had extremely immediate requirements, the European customers, they bought from nearby countries, especially Turkey, and the US customers, they bought from the US itself. So, some impact of this Red Sea, crisis also has happened on, on our order flow also. But we are working with our customers to, to smoothen that out, and hopefully, in this year, we are expecting to do much better business from them.
Okay, great, great. And in your opening remarks also, you had mentioned that you will be doing 25%
We are
plus.
unable to
Hello.
hear you. Yeah, you are audible.
I can hear you.
Am I audible now?
Yes, sir.
Hello.
Please go ahead with the question.
Yeah.
Yeah.
Yeah, just wanted to understand, in the remarks and the presentation, you also said that the EBITDA growth would be 25% in the coming years. So could you tell how would you achieve that, and what would be the revenue growth opportunities in which geographies, in which product line you are seeing? And last question is on the metal blow. How much it did contribute in Q4?
So, I answer the last question first. In terms of metal bellows, so the project has still not been started. So we have placed order for the machines, and we have placed the order for, all the ancillary equipment and the testing equipment. So the project itself would be completed by December. So the real impact of this project, you'll be able to see in the next financial year. Because once we start the production, obviously the first couple of months goes into a lot of trials and tests, and then obviously the real impact would be seen after that. So metal bellows, currently there is nothing, there is no contribution of metal bellows to our current sales.
Okay.
With regards to the EBITDA, growth that we expect in the upcoming years. So one is that we are slowly focusing our sales from hoses to assembly products. So when we do that, automatically the margins increase, because the assembly products has better margins as compared to when we sell the hose, in roll form. So that will help us increase both our top line, but will also help us increase our bottom line to a much greater extent.
Okay, and the geographies you would be focusing on apart from North America and Middle East?
So geography is right. Our focus this year is North America and Middle East, because Europe, is a market which has almost flattened out, and obviously Europe has its own issues with regards to the economies, and also our focus, although Europe will remain our number 2 market after the US, but our entire focus of our team is to build the business in the USA and also in the Middle East region, because the Middle East also has a lot of potential which we have not yet encashed.
Okay, last question on my side. With the China reopening, are you focusing on that geography as well?
No, so right now we are not focusing on exporting our products to China. Because, and obviously in terms of competition, China is actually not our competitor, in this segment of ours. It's mostly, like I said in the earlier answer, that our competition comes from European and US manufacturers. So China is not our focus right now.
Okay, yeah, that's it from my side. I'll come back in the queue. Thank you.
Thank you so much. Thank you.
Thank you. A reminder to all participants, you may press star and 1 to ask questions. Ladies and gentlemen, in order to ensure that the management is able to address questions from all participants in the conference, please limit your questions to 2 per participant. Should you have a follow-up question, we request you to rejoin the queue. We have our next question from the line of Saurabh Shah from Home Advisory. Please go ahead.
Hello.
Yes, sir.
Hi. One question was, regarding, as you mentioned, the extra freight costs due to the, geopolitical issues and all that. Going forward, are you planning to change that at all, so you reduce the variability in your margin, these kind of extra costs? Are you able to pass this on or bid X works or something like that?
So actually, when COVID happened, and at that time when we saw a significant increase in the prices of the containers, so at that time also we had taken a call, and we work with our partners. Obviously, that some of the costs would be borne by us and some of the costs would be borne by them. So we work on a mixed model of FOB and CIF. So some of the customers, they are on FOB basis. So in that we don't have to bear the freight cost. But on the other hand, in that we face the cost of increasing in inventory, because if the freight cost is very high, so the customer tends to delay the booking of the container. And in case of CIF, obviously, since we have to bear the freight cost, that leads to a direct impact on the bottom line. But the advantage in that case is obviously that the inventory and the booking is in our control, so we don't face the cost of the inventories. So we always try to make sure that we balance it out, and we are always in touch with our customers, with regards to any increase or even in a decrease in the freight cost. So whenever there's an increase in the freight cost, we also speak to our customers and try to pass on as much as possible. And simultaneously, when there is a significant decrease in the freight cost also, we try and speak to customers and pass on the benefit to them as well. So we work, on both aspects with our customers.
Also, again, staying on the same question, so this time if you take out those aspects where, your customer didn't, make up for the extra cost and all that, then what, assuming, the same basis as last year, how much will your EBITDA margin, kind of get impacted by this, extra cost? Let's try to compare like for like.
Obviously, I won't have the exact data, exact details, but I would say at least 25 to 30 basis point minimum. The EBITDA margins would be higher at least.
Okay. The next question was, I think you addressed it earlier. I just want to clarify. So, in terms of what is the total market for the replacement and the project supplies in the US, and how do your current the current SKUs, what kind of eventual market can you target? Can you give us a sense of that?
The overall market globally is about 3.5 billion for just the stainless steel flexible hose market. We have about 1 to 1.5% market share. But like I said, that the market, and obviously a large portion of that market is from US and Europe, because of the demand from those sectors, and that is where you see that bulk of our revenues also, almost about 70% of our revenues is from those two markets. So bulk of our market is also there, and the focus of our focus also in this financial year is obviously on the US market, and another is the Middle East market, because that is an area we feel that there is a demand for our products, and we feel that is an opportunity that we have still not yet in cash, and that is where we can see some good potential in the upcoming years.
What I meant was, for the current SKUs, so not the total market theoretically of these steel products, but, for example, what you have capacity for and you have certifications for, how large is that market?
It will be hard to give a number for specific SKU-based market, because I'm talking about the market for the SS flexible hose. So some SKUs or some products may fall in it, some products may fall out of it. So it will be hard to give a specific number based on the SKUs that we have, because generally in our industry right now we have about 2,400 SKU. Last year we had about 1,700 or so. So every year we build up our SKUs to cater to the needs of the end customer. I'll just give you an example, like one of the companies, one of the large MNCs who is our competitor, they have, I think, more than 50,000-60,000 SKUs from the data that I have, their last data. So the more product segment you enter into, the better you can cater to both your existing customers and your new customers. And that is the reason why if you see that we have entered into composite hose and into metal bellows, because a lot of our customers are already buying this product. and also a lot of our potential customers who we were not able to capture. But one of the reasons why is that because they wanted somebody who can supply them a basket of products. They might not have a full container requirement of of the assemblies, but they might have half a container requirement of assemblies and a quarter container of composite hose and a quarter container of bellows. So by increasing our product portfolio, we are able to cater to a larger customer base.
What company is this? Sorry, you mentioned this company with 50,000 SKUs. What's the name of this company? This competitor?
Parker Hannifin.
Parker.
Overall, they must be having I think I would say lakhs of SKUs, but in our product segment or in the segment that we are in, or we can enter, they have I think about 50,000 SKUs. From data that I have. Parker is a listed company, so you can probably go on the website and you'll be able to get all the details.
Thank you very much.
Thank you, sir. We have our next question from the line of Dipesh Kashyap from Invesco. Please go ahead.
Yeah, hi. Thanks for taking my question. Sorry, Asad, I joined late, so pardon me if there's a repetition, but I was looking at slide 17, where you have given the production data, right? So hoses you have given the 32% growth in the production volume of hoses. And also, I think you have mentioned that the proportion of your value-added products, that is fittings, has increased. So when the production has increased by 32%, the proportion of value-added has also increased. So why does revenue has increased only by 18% in FY24? And also gross margin has fallen, right? So if you can just explain that.
Raw material prices has decreased by about 25%.
You think the price? So you have passed on the prices?
So some of the pricing we have to pass on. I don't think you're in an industry that I can take 25% in my pocket.
No, right, but still I'm saying that your gross margin, if I look at last year it was 36.9, and right now it's 36.6 only. So when your proportion of fittings has increased, ideally the gross margin should have increased, right?
So the cost of the fittings have not gone down. So in our case, the raw material when I talk about it's the coil and the wire. But the fittings are such that so what happens is sometimes say for example the hose could be 100 rupees and the fittings that go onto the hose can be of 100 rupees. And sometimes the hose can be of 100 rupees and the fitting that goes on the hose, is of only 10 rupees. So that is the difference where the gross margin can go up also because of the fittings is basically as required by the customer. So the more complicated the fittings, the better the margins for us.
And the fitting you're not doing in-house, you're basically outsourcing it, right? You're taking it from outside.
Yeah. Till obviously right now also we are outsourcing. In this year we plan to slowly phase out the outsourcing, and to the extent possible, whatever High Dare can make, we'll be shifting, slowly to production, from High Dare itself.
Okay, so when your raw material price of fitting has not gone down, so maybe you are not passing also, right? Your final product price is also higher in fitting. So actually the revenue growth should have been higher, right? So just not like trying to understand the dots here.
Because it's a product mix that works. So what happens is sometimes, so when we sell larger sizes of orders, in terms of the large diameter, in that the gross margins are higher. So, but we say, when we sell the smaller diameter, the gross margins are slightly lower. So our gross margins also depend on the type of product that we sell, the diameter of the assembly that we are selling, the final assembly that is being welded onto the hose. So there are a lot of parameters on which it depends. Also, if you see that despite the decrease in the raw material prices, our volume sales have gone up, and that shows that if in case of a constant raw material prices, we would have had a much higher turnover.
Okay. So, secondly, you're guided for 25% EBITDA growth, right? So, ideally, your margins should go up as your fitting proportion is going up. So how are you basically building up the revenue growth? Because I think your capacity is increasing everything, so ideally, your revenue growth should be 20-25%, right? So why the EBITDA growth is just 25% you're giving guidance on?
So EBITDA, so first a couple of... So one is because of the increase in the freight cost, right? This is something if in case the freight cost over the next 1 year goes down, then obviously our margins would become better. But that is something which I cannot predict right now. So hence, on the current, higher freight cost, we have taken the growth. Secondly, also that we have a lot of new projects that are, ongoing, and some of the cost of the projects are impacting the P&L, which ultimately over the next couple of years might, you will be able to see the results of that, in the top line as well. So in our industry, so we work, more from a long-term perspective, because our it's not like a consumer industry, or it's not like a normal commodity B2B business where you have, every quarter based performance. So because our projects and a lot of our new customers, especially the OEMs, the customers, they take almost sometimes a year to 2 years to onboard. And after onboarding, they give a small order, and then over the period of next 3 to 5 years is their order flow, increases. So in our industry, it's, we play on a longer term cycle. So right now some of our team members are actually working on certain projects that we are planned to have in the next financial year. So we have to work on, on the future aspects because of the longer, cycle of our customers.
Understood. So largely, you're basically building on the EBITDA margin to remain similar. You're guiding 25% growth, but the EBITDA margin goes up, obviously the growth will be higher. That's the understanding?
Yeah. So obviously, we are being, conservative, yet we are being aggressive, in the sense that I'm expecting our growth both in terms of the top line and the bottom line to be better than last year. Our margins, our EBITDA margins in terms of basis points should be definitely much higher in the current FY as compared to the last FY, and overall over the next 4 to 5 years, our EBITDA margins should come to about 25% in terms of margins.
Got it. Thank you, and all the best.
Thank you.
Thank you, sir. We have a last question for today from the line of Nitin Gandhi from InnoQuest. Please go ahead. Mr. Nitin, are you there?
Hello. Yeah, hi. Thanks for taking my question. This metal bellow, when is the phase 2 likely to be operational? And what is the amount you are going to spend?
So once the phase 1 is streamlined, then we'll be looking at the phase 2. So the phase 1 is planning to be completed in December, and once the entire production is streamlined and the production is up and running on a smooth basis, at that time we will, start the investment for phase 2. Obviously, the figures have not yet been finalized in terms of the capex, because we'll wait till phase 1 is completed, and then we will look at the phase 2 expansion to start.
How much amount is for the phase 1 capex?
About 45 crores.
And what is likely asset turnover of that?
So our asset turnover ranges in the range between 4 to 5 times generally. But in case of metal bellows, because it is a new project, so a lot of the machines that we are buying, it will be actually used for both phase 1 and phase 2. So some of the machines that we are using, it will be used for both phase 1 and phase 2. So the real asset turnover, the final, asset turnover ratio you'll be able to analyze only once phase 2 is completed and fully operational.
So in that case, for phase 2, capex will be little lower than the phase 1.
Yes.
Okay. And as far as assembly fittings stations are concerned, are you likely to increase to beyond of current 29 to what level?